In a democracy, agreement is not essential, but participation is.
But participation is.
Participation is.
It's a responsibility that goes back to the founding of our country.
A need for every American.
Every American.
Republican.
Republican.
Democrat.
Democrat.
Independent.
To inform themselves about America's role.
America's role in the world.
To keep America competitive.
Competitive.
And defend our common interests.
In a dangerous and often unpredictable world.
Join us.
Join us.
As we discuss
today's most critical global issues.
Join us.
Join us.
Join us.
Join us.
For great decisions.
Prepare.
Prepare to discuss the world.
Great Decisions is produced by the Foreign Policy Association, inspiring Americans to learn more about the world. Great Decisions is produced in association with the University of Delaware. Sponsorship of Great Decisions is provided by PricewaterhouseCoopers LLP, the AARP Office of International Affairs, and the European Commission. Coming up next, should America regulate global finance?
Welcome to Great Decisions, where Americans make tough choices on U.S. foreign policy. I'm Ralph Begleiter. This week we ask, should the U.S. take the lead on global financial regulation? To help answer the question, we'll be joined by Great Decisions participants in Nevada and our experts Peter Wallison, a fellow in financial market studies at the American Enterprise Institute, and Dean Baker, co-director of the Center for Economic and Policy Research. Thank you both for being with us.
Good to be here, man.
Dean, first question, simple question. Should the U.S. take a lead in regulating global financial matters?
Well, I don't really think we're in a position to do that at this point. I mean, certainly after the blow-up we had in our financial markets in 07, 08, I don't think a lot of people are really looking to the United States as a model. Furthermore, I don't think the rest of the world, it's not as though they're just going to say, okay, what does the United States want to do? We're going to follow. They all have their own interests, their own powerful business groups, and they aren't just going to lay down and agree to anything we set out on the table. I think the most important thing for the United States to do is try to get its own regulatory system right, and of course we will learn from other countries will learn from us. We don't need uniformity in regulation. What we need is good regulation. We need some comparability in regulation, but it's not as though we're going to draw up a set of regulations and Europe, Japan, the rest of the world will just follow.
If they don't want to follow the U.S. because of the mess the U.S. made, as you indicated, wouldn't they be also able to say, or in a position to say, you know what, U.S., you broke this thing, you go ahead and lead us in trying to fix it? That's not reasonable?
Again, they all have somewhat different systems, so it'd be very difficult. We aren't going to get a uniform system of finance, and that's probably a good thing. I mean, it's good to have some experimentation, some differentiation. So I think it's, the other countries, the rest of the world, I think basically would like to see the U.S. clean up its own act. And, certainly they were burned in many cases. I mean, you had situations, for example, they assumed that investment-grade ratings by our bond rating agencies meant something. And to surprise, I think, of many big investors, and I'm not talking small investors, I'm talking major insurance companies, major banks, they discovered that the bond rating agencies don't do due diligence. In other words, they don't review assets, issues in great detail. They simply take at face value the information given to them. And as a result of that, they took many issues and rated them investment grade when they certainly didn't warrant that sort of rating. But what that meant was investors in Europe put lots of money thinking that these items were very low risk, when in fact they were very, very risky assets and should have commanded very high interest rates.
We'll come back to that in a little bit, but Peter, for the moment, simple question, should the U.S. take the lead in regulating global finance?
Well, of course, the U.S. Financial system is the world's most important and powerful one, so you would suppose that the U.S. would be the right group to be leading the world in this area. My question would be, what are we doing in terms of regulation? What is regulation, and are we doing it well in the United States? For example, in 1991, we adopted a very strong bank regulation system, the FDIC Improvement Act, called FDICIA in the United States, and that did not prevent us from having what was, in effect, a huge banking crisis in 2008 and 2009. So if we are supposed to be having a world-leading regulatory system, we ought to rethink our regulatory system so we are doing it right. My sense is the only effective way to have a good regulatory system is to make sure that the regulators cause financial institutions to be more transparent, require more information about financial institutions to be distributed to the public and to investors. It's investors, especially creditors, who take most of the risks associated with financial institutions. And if they don't know what's happening there, the belief that the regulators are able to follow financial institutions and the risks they are taking actually creates moral hazard. So what we want to do, I think, is make sure we have much more information coming out about our financial institutions and not simply impose more restrictions on them.
Let's talk for a minute about whether it's possible to regulate banks in such a way that it keeps the United States competitive in the global market and yet prevents the kind of meltdowns and abuses, arguably, that took place during the current crisis. Let's turn to our Great Decisions group in Nevada and see what they have to say about that.
I think we should have enough regulation to get rid of the abuses so that we can at least understand what's coming out of the banks and understand their products. At the same time, I wouldn't want to get rid of any competitive advantages that our banks would have compared to other countries.
I think we do need to move towards regulating more. I mean, obviously, we swing back and forth and you can go too much one way or the other. But the things that they were talking about just now, like increased transparency, I think that that's an obvious, solution, and that can help.
I think that, less regulation got us into this mess, so more regulation might get us out of it, but I'm not an economist by any means.
I am a huge believer that the cause of this was overregulation. Capitalism, what this system is supposed to be, is based on the pursuit of self-interest. And, people being selfish, in a way, helps everybody. It's small business that create jobs, not the government. Especially here in Nevada, 88% of people are employed by small business. The remaining of people that are employed, small business. It's not these huge companies that come in. It's small business, it's private individuals that want to make a difference and do something for themselves, and they employ most of the people. Less regulation is going to make it easier for those businesses to prosper more and employ more people, and that's the only way we're going to get out of this.
It's not really an either or. We can still clean up some policies to make sure that we're not encouraging giving loans to people who can't afford them, while at the same time, like the gentleman was saying, working on financial regulations to make sure that if the U.S. puts these harsh, or very more strict regulations in place, people just don't just decide to invest somewhere in Europe. That hurts the U.S. economy.
Peter, is it possible to regulate banks in the United States in such a way that accomplishes two things? One, it prevents abuses of the sort that resulted in the financial crisis, but still keeps American banks competitive in the global environment.
Well, I think that's a real question. I don't think the question of competition in the global environment is significant now, because it's obvious that what the global regulators are doing is getting together and attempting to adopt the same rules for all financial institutions, or particularly banks, within their jurisdiction. So the idea is to make it competitive, make the international financial world competitive by having the same general regulations, the same capital requirements and that sort of thing in every country. The more important question is whether regulation is effective in reducing risk. And there I think we have grave doubts, I do at least, from looking at the experience we've had with regulation in the United States and elsewhere.
You have grave doubts about whether it's possible to do? It's not possible to have regulations that will accomplish it?
You can have regulation, but it's not clear that regulators, even with regulatory power, are able to prevent banks and other financial institutions from taking the risks that might get them into difficulty. And in fact, regulation might be creating moral hazard so that they are taking more risks. Let's assume, for example, that banks are required to hold more capital, which is now what is supposed to be better regulation. Does holding more equity capital reduce risks, or does it induce banks that are interested in return on equity to take more risks? The assumption is that more equity capital somehow reduces risks, but that's not entirely clear.
Dean, I don't know if you agree with that, but if you do, that it's not possible to do it, what does that mean for individual investors or even large investors not being able to count on on the anti-abuse aspects of this situation?
Well, I think I might be a little more optimistic about Peter than on regulation. I think we actually haven't done that bad a job. I mean, you know, the 2007, 2008 was a serious meltdown, no doubt about it, but the fact was we went a long time without a serious meltdown. So I would be a little more positive, you know, on the track record of regulation through the 50s, 60s, 70s that kept the banking system on the whole pretty much crisis-free. So we do, I think, have a decent history. But there are certainly problems with regulation, and I'd focus on a couple different issues. One is, you know, Peter's exactly right, this issue of moral hazard. I do think capital alleviates it. It doesn't get rid of it, but the point is the banks are risking their money rather than simply the government's money or the depositor's money, the lender's money, if they have a substantial capital buffer. Now, it gets back to this issue, though, how do you enforce that? And we've often had a history where regulators haven't been eager to step in because by its nature, that's going to be a difficult thing to do. If you have to tell a major bank that, you know, you aren't meeting the capital requirements, you have to raise more capital, well, major banks have powerful friends in Congress and Treasury, other places. That's not going to be an easy thing to do. So we can't assume that regulations will be easily enforced. But I do think, in principle, regulation can reduce risk, and I think, in general, it has, for the most part, been a positive history. But obviously, you've had major disasters, with the most recent one being the most serious.
Is it just a case of regulators not being ready to step in or being fearful of stepping in? Or is it a case of the financial instruments and the financial arrangements that banks set up being so complicated that even the best regulators, and maybe even the bankers themselves, don't understand them well enough to be able to step in and say, here's what has to be done?
I think the two go hand in hand. I mean, it's the regulator's responsibility. If they don't understand, you know, there's new financial instruments being created and they don't understand it, well, they should have the power, and it should be their obligation to say, well, wait a second, slow things down until they're sure they know exactly what this new instrument is and know how to treat it, know what sort of capital requirements are necessary, know what sort of transparency requirements are appropriate. And clearly they were not doing that through the period of this buildup of the housing bubble, 04, 05, 06, and 07. That was setting us up for the sort of fall that we had.
Peter, you agree with that? You think that
Not exactly.
If they don't understand it, they shouldn't. They should put a hold on it?
I think one of the worries about regulation is that it will reduce innovation, will prevent change, will make things more expensive for consumers. But there's another factor here that we haven't talked about, and that is who is ultimately in control of the regulators. Let's take, for example, the question of subprime lending. I happen to believe that it was subprime lending, bad lending on mortgages that actually brought down our financial system. Some regulators, particularly the Federal Reserve in the United States, had the ability to control subprime lending. They didn't do it. One of the reasons they didn't do it is that if they had tried to do it in 2004, 2005, 2006, subprime lending was very good for many people in the United States who had not previously been able to buy homes. And if the Federal Reserve had attempted to stop that from happening, they would have encountered tremendous opposition in Congress.
I want to come back to something Dean mentioned earlier in the program, and that was the issue of hedge funds and credit ratings, credit rating agencies and so on, not actually checking out the contents of what they were regulating. Let's ask our Great Decisions group in Nevada about that.
If you have all of these regulators and regulations in place, it really comes down to enforcement. You can have all of these bodies and rules and laws, but unless someone actually enforces it responsibly, it's not going to help at all. And if anything, it just causes more problems because people don't understand what's going on.
Nobody's alike. Everyone has a different system, so everyone has to make their system work before you can make a global economy work.
It's an incredibly complex area, you know, and this is part of the problem too, because you know, then we have people in Congress making rules and overseeing some of this stuff, and they don't understand it. And you know, even some economists don't really understand what's going on.
I think that with an economy of $13 trillion, dollars for GDP, I think that anything that we do nationally is going to have a big effect on pretty much everything globally. You know, whatever butterfly flaps here, it's going to make a storm in China, essentially. So I think that we do need to regulate here, but whatever we do here, we need to realize we'll have a big effect globally.
Peter, what about the allegation that the credit rating agencies really were asleep at the switch and weren't checking what they were supposed to be checking? And can that be fixed?
At least up to now, rating agencies have been statistical rating agencies. They have not been due diligence rating agencies that actually go in with experts and look over mortgages or other assets. They're told, here's where some of these are from, this is that area, here we have another set from another area in the United States, and the question of whether both would fail at the same time is the sort of thing that they look at. I think in the case of mortgages, they did not expect that there would be so many failures in different areas of the United States. In other words, the United States was much more correlated in its failures than they expected. Now, that's only to say that this is the way regulators, that is, rating agencies, worked now or have worked in the past. We could turn them into something else. We could turn them into due diligence organizations. But in that case, they would be much more expensive, and it wouldn't necessarily be worthwhile to be in that business or to use them.
Dean, do you think most people understood that the rating agencies weren't actually checking anything?
Well, I think a lot of people certainly didn't. I mean, more sophisticated investors, I'm sure, did, but there were an awful lot of investors that I think did not understand that they were not due diligence, they're not performing due diligence. But also, I should point out, there's a basic issue here of a conflict of interest, that the issuer pays the rating agency, and the rating agency wants to be reemployed by the issuer, and that gives them an incentive to give better ratings for an issue than they might otherwise, because they know if they give a bad rating, then they're less likely to be called back. You have the same sort of issue with real estate appraisers. This is why they changed the rules on real estate appraisers, where the bank that's calling for the appraisal no longer selects the appraiser, because the appraiser knew if they didn't make a high appraisal, the bank wants to issue the mortgage, if they didn't make a high appraisal, they won't get called back again. You have the same problem with the credit rating agencies, and in the Dodd-Frank bill, there was actually an amendment proposed by Senator Franken that would have taken the hiring away from the issuer. Now, that got removed or delayed in the conference final bill, the conference report, but that would take care of this conflict of interest.
Coming back to the broader question of whether the U.S. should take the lead here, were European regulators, banks, credit agencies, or any of these institutions any better at doing what was supposed to be being done than the American institutions were? Peter?
Well, I don't know about the Europeans, but if we looked at Canada, for example, Canada shares a lot of commerce with the United States, a lot of trade. Our economies are closely interlinked. Canada did not have this problem. Canada's regulatory system seemed to work well. Now, why was that? One of the reasons was that Canada did not allow subprime loans to be made in the numbers that was permitted in the United States. And as a result of that, when the subprime problem arose and many of these mortgages failed, Canadian banks were not as severely affected. So it isn't exactly a problem of regulation in general. It's a problem of the things that the government did to encourage certain kinds of activities in the United States, which eventually caused us substantial financial problems.
We've seen collapses in Spain. We've seen collapses in Greece. We've seen Ireland go under. We've seen Iceland go under. The United States, of course, as well. Is there a common theme there? Anything that can be fixed together?
Well, I think there is. One common theme is that this is all driven by housing bubbles, asset bubbles, and that's why the failure to regulate turned out to be a very big problem, because if you had done poor regulation, it goes beyond subprime, by the way, it was Alt-A mortgages. I make this point because you had very bad mortgages that had nothing to do with poor people buying housing. Alt-A were mostly middle income, upper middle income people, in many cases buying investment properties, very bad loans. But in any case, had you not had a sharp decline in house prices across the country, this wouldn't have been a big problem. If you had a lot of bad subprime mortgages out there, or Alt-A mortgages, and we had a normal housing market, then the system could have easily withstood it. It was only because we saw a 20–30% drop in house prices that it went together. And you saw the same sort of phenomena in Ireland and Spain, other parts of the world.
Let's turn to this basic question of whether in those other parts of the world people would even dream about letting the United States lead the way in coming up with the answers to this. Let's ask our Great Decisions group in Nevada what they think about that.
We obviously need to work on our own economy, and that can be a priority, but that doesn't stop us from being able to lead the world also. We have plenty of people in our government who can, go speak to other countries on WTO or whatever medium they choose to talk about those regulations, and we can work on our economy. Obviously ours is priority, but I don't think that that needs to be an either-or question.
You could do maybe like the G8, the G20, I think would be a good place where you have some of the top economies come together and look at where it hasn't hurt countries as much, maybe take some of their models and try and work that out. Like I'm sure places like Canada might not be the best for everywhere, but if you take a few aspects from there, maybe from some of the Scandinavian countries, not Iceland, but you know, the other countries that it didn't do as much damage might work.
Yeah, people getting together for a governance to make sure there's not, you know, an advantage for one country over the other. I think that stuff has to be done and probably should be done in a forum like the OECD. Should smaller countries be a part of this? We have to recognize too that, you know, the more countries we bring in to the decision-making process, the more difficult it's going to be to come to an agreement that actually does something.
Because America is such a big player in the banking system, and because we have so much to do with how the system started and how it operates and stuff, if we do good change, other countries might be able to take our lead.
Well, if you look around the world and the world looks back at the United States, is there anybody out there, Peter, who might say, yeah, let's let the United States lead us out of this problem, fix the regulations?
I think the United States will continue to be the world leader in at least attempting to bring all the nations together in a single sort of regulatory structure. And it's got to be that way because the United States has the most powerful economy, most powerful financial industry. And so unless the United States is part of any agreement, there can't really be any kind of effective financial regulation throughout the world. But again, the question is, are we leading the world, and we will lead the world, but will we be leading the world in the right direction?
Dean, what do you think about the question of whether anybody's going to let the United States lead?
Yeah, well, I don't think the rest of the world is sitting around waiting for the United States to tell them what to do in that respect. I think, you know, obviously we're a player at the table, there's no doubt about it, but, you know, it's not as though people are coming there without their own ideas and their own regulatory structures. So at the end of the day, I think we will find areas where we agree. We just had the Basel Accords in Switzerland about bank capital requirements, and you know, obviously the U.S. was a big actor in there. We were pushing for higher capital. At least this is, you know, they're held in private, but I mean that's, you know, the popular understanding. The United States was pushing for higher capital requirements, many of the European countries wanting lower ones. But I think that's the sort of agreements we're going to get. We're going to get sort of broad agreements. How that's implemented, I mean, that's going to be a very, very big issue. You know, what counts as capital, and of course you get accounting rules which make a huge difference, because what a bank could say is their capital depends entirely on their accounting, because different accounting, they may be showing that they've taken very big losses on some things which come directly out of capital, whereas if we have more lenient accounting, that's all capital.
And the broader you make the group, as I think both of you are suggesting that it be broader, don't you run the risk of having more people involved in the group who know less about the very sophisticated instruments and financial environments that we're engaged in? How is that going to make it any better? Peter?
Well, I'd say it's better in the sense that it's considering more issues. Seriously, we do have to worry about the fact that regulation could stifle change and could stifle economic growth. Economic growth is probably the thing that we want more than anything else. We want to be sure that we have some sort of balance.
More than stability?
Yes, I think more than stability. Stability, as Dean was suggesting, we have not had a serious financial crisis since the Depression. That's 70 years. And so the mere fact that we had a financial crisis in 2007 and 2008 should not lead us to assume that we have to clamp down on financial activity so that we have only stability. We should be allowing enough free play in the organization, in the structure, so that there can be change, innovation, and growth.
What's the organization for this future world of financial regulation? Is it a group of nations that already exists, the G8 or the G20, or some other group that doesn't exist yet? What do you think?
I think we're probably going to continue to see what we have seen as a hodgepodge. You know, some things get decided with Basel, some are decided G20. We have the IMF sort of play a role prodding countries, not always in a good direction, I'll say, at least in my view. But I don't think there's a way around, you know, having sort of a hodgepodge of international organizations and conferences where these issues are decided, as opposed to sort of a single one taking the lead and laying down the law.
And Peter, do you see a group out there that's likely to satisfy your definition of how this ought to be regulated or handled in the future?
There's no group yet, but I would think under the G20, a group could be assembled with a broader perspective on the question of how we handle global financial transactions. to make sure that we are not focusing solely on the question of stability or the things that the regulators are interested in, which is regulatory power.
Peter Wallison of the American Enterprise Institute and Dean Baker, the Center for Economic Policy and Research. Thank you both for being with us on Great Decisions. Thank you as well for joining us on Great Decisions, and special thanks to our group in Nevada. To join a Great Decisions group in your area, you can visit greatdecisions.org. We'll see you next week. I'm Ralph Begleiter.
To order a DVD of this series, visit shoppbs.org or call 1-800-PLAY-PBS. Great Decisions is produced by the Foreign Policy Association, inspiring Americans to learn more about the world. Great Decisions is produced in association with the University of Delaware. Sponsorship of Great Decisions is provided by PricewaterhouseCoopers LLP, the AARP Office of International Affairs, and the European Commission.
The last 2 years in our city and our state, we have the highest unemployment in the nation. Tourism has really been hurt. People aren't going, conventions aren't being held, and it's really hurt our economy.
My dad lost his job just before I graduated high school, and with the prospect of going to college, that was like, a pretty bad blow. At UNR here in Nevada, it's they cut a lot of stuff, cut a lot of spending. A lot of programs got cut.
I think a lot of people are thinking, oh, maybe I'll just go to more school. Maybe I'll go to grad school and hope that the economy is better then. But then not everybody has the money to do that, and then you might just end up in more debt.